Debt is a form of human bondage that traps people in an endless cycle of spending and not being able to afford the cost. However, it has also been said that debt is a necessary evil for living in society. When we borrow money, it gives us the means to meet our basic needs while still having time to save and invest for other goals. Debt can be useful when used properly, but it's dangerous when misused. Debt is a touchy subject. People in debt are often seen as irresponsible or careless. However, the reality is that debt has become a necessary part of life in today's world. The cost of living is simply too high for most people to be able to afford everything they need without borrowing money. However, debt can be a tool to help you reach your financial goals if used wisely. Here are some ways to start taking advantage of debts. 1. Startup businesses use debt to meet their capital formation and expansion needs. In modern economy, debt is often seen as a necessary evil, something that businesses must borrow to finance growth and expansion. However, this view is changing. A new breed of business owner is emerging, one who is not afraid to use debt to create wealth. The need to access capital is one of the biggest challenges faced by startups, as they require a large amount of money to develop new technologies and products. That's why many startup businesses are turning to debt financing, which can help companies meet their capital formation and expansion needs. So, how do rich people make money out of businesses that were financed by debt? It's quite simple. They borrow money to finance their businesses and then use the businesses to generate income. This income is then used to repay the debt, with the business owner keeping the difference. Some companies borrow money and then use that money to make more money. This may sound like a risky proposition, but there are plenty of scenarios where it has worked out very well for companies. In some cases, companies use debt to finance expansion plans or to make acquisitions. This can be a great way to grow a business quickly. Other times, companies use debt to buy back stock or to pay dividends. This can be used to return money to shareholders. 2. Credit scores. Credit scores are a way to measure your credit history and make decisions about you as a borrower. Your credit score is an indication of how likely you are to repay your debts, and it's calculated based on your payment history. In general, the higher your score, the better your chances of getting approved for loans or other forms of credit. Credit scores are based on a formula that's used to determine your credit worthiness. The formula is made up of several different factors, including the amount of debt you owe, how long you've had that debt, and whether or not you have a history of making payments on time. Credit scores are used by lenders, like banks and credit unions, to determine whether or not they should give you credit. If you have a good credit score, for example, then lenders will be more likely to lend money to you and at lower interest rates. Because of this, business owners use their credit scores to ensure that they're making the best possible decisions when it comes to their finances. If they don't have enough credit available to them, they won't be able to take out loans they need. This means they'll have less money in their accounts, which means they might not be able to buy things like office equipment or materials for their business. 3. Hedge funds. The global economy is experiencing a bubble of staggering proportions, and the vast majority of people are not invested in it. The burst could come from any number of places, but one common concern is that the variety and amount of debt across the world will eventually lead to problems few can predict. For those who are invested in this unsustainable system, there's a silver lining: hedge funds. Hedge funds offer a way for investors with lots of money to invest in risky markets without putting all their eggs in one basket, which can be advantageous. Hedge funds are one of the pillars of modern finance. They offer professional investors a way to diversify their portfolios, reduce risk, and make better returns through more thoughtful and complicated trading strategies. A hedge fund is best defined as an investment pool that combines multiple investments from sophisticated investors with expertise from professionals in the field, such as management or trading, to generate a diverse portfolio that mitigates risk while also offering increased potential return opportunities. Hedge funds are a way for the rich to get richer. These investment vehicles are typically made up of a group of wealthy investors who pool their money together to earn high returns on their investments. The general idea is that hedge funds make money by borrowing money from lenders and investing it in financial assets, such as stocks or bonds, or other types of securities. When those assets go up in value, hedge fund investors will see their returns increase. But if they go down in value, they'll have to pay back their lenders, and this can be very costly. So hedge funds tend to focus on investing in assets that are considered less risky than others, like government bonds or certain kinds of stocks. 4. Refinancing. Debt refinancing can be a great way to save money and pay off debt faster. By refinancing debt, you can potentially lower your interest rate and monthly payment, freeing up more money to save or invest. Before refinancing debt, it's important to understand how it works and what the potential risks and benefits are. The rich make more money by refinancing their assets. This is because they have the financial resources to take on more debt. They can also buy a property at a higher price and then refinance it for higher than its current value. But most of the time, they buy properties at a low price, refurbish them, then lease or sell them at a higher price. Refinancing can be a great way to save money, but it's important to do your research before you take the plunge. When you refinance, you are taking out a new loan from a different lender with a lower interest rate and higher monthly payments. If you're not careful, this could leave you with more debt than before. Even though refinancing is often cheaper than paying off an existing mortgage loan, it's worth doing some research before making any decisions about refinancing your home. 5. Foreign exchange. Forex is short for foreign exchange, and it's an online trading market where you can buy and sell different countries' currencies. There are a lot of different types of Forex trading platforms out there, but most have the same basic features. They allow you to buy and sell currency pairs such as one of the most popular, Euro and US dollar. You trade one currency against the other within a pair in the hope of making money when the values fluctuate. The big difference between Forex and other types of currency trading is that Forex allows you to make money by taking advantage of foreign exchange rates. This means you can buy low and sell high when there's a discrepancy between two different currencies. For example, if one country has a currency that's stronger than another country's currency. You can also borrow money to trade in Forex, the reason why you might want to borrow money on these platforms. This means that you can use this type of lending platform to start trading without worrying about having a lot of cash in hand. It's also important to note that most Forex lending platforms require very little collateral for them to approve loans. Don't go out there thinking that Forex is an easy way to make money. It requires a good knowledge of the markets to make money, and if you don't know what you are doing, you can lose massive amounts of money as well. This doesn't mean you need to be afraid of it, but it does mean you need to learn more about it before diving into the deep end. When you're in debt, it can seem as if there is no easy way out. However, this isn't always the case. There are many things that people with debt can do to generate more money and get back on their feet. You'll probably have to make sacrifices. You might have to give up certain things or spend less on the other necessities of life. While it's a tough decision, there are still opportunities that can help you generate more money with debt than usual. For sticking around, we want to give you a bonus. Understanding bad debt versus bad credit. There is a lot of confusion when it comes to the terms bad debt and bad credit. Many people believe that they are one and the same when, in reality, they are two very different things. Here is a breakdown of the differences between bad debt and bad credit. Bad debt is when you owe money to someone and you are unable to pay it back. This can happen for a variety of reasons, such as losing your job or having an unexpected medical emergency. Regardless of the reason, if you cannot pay back the money you owe, it is considered bad debt. Bad credit, on the other hand, is a reflection of your financial history. If you have missed payments or defaulted on loans in the past, this will show up on your credit report and will lower your credit score. Having bad credit can make it difficult to get approved for new loans or lines of credit. So, as you can see, bad debt and bad credit are very different things. If you find yourself in a situation where you cannot pay back the money you owe, it is important to reach out to your creditors and try to work out a payment plan. And if you have bad credit, there are steps you can take to improve your credit score over time. Remember, this video just touches upon a few basics of investing. We are not financial advisors. Don't go out there and start investing based solely on this video. You need to learn for yourself what is a good investment for you based on your and the market circumstances. Take responsibility for yourself because, simply put, your finances are solely your responsibility. That's it for today. See you next time at Lux Diva.